One day, a penguin wanted to start a fish business. Penguin had a big dream. Penguin wanted to sell fish. Penguin wanted to grow fish. Penguin wanted to become a very rich penguin. But there was one small problem. Penguin had no fish money. So Penguin thought, maybe I robbed the ice bank. Bad idea. Penguin tried. Penguin failed. Penguin got chased by angry ice guards. So Penguin came up with a smarter idea. Instead of stealing money, Penguin asked rich penguins to invest.
Here's our business plan. We invest in fish, and the returns are huge. Interesting. Tell us more.
Penguin said, give me fish now, and in return, I give you a small piece of my fish business, and that is called a stock.
What is a stock? A stock is a small ownership piece of a business. So when rich penguins buy stock, they become partial owners of Penguin's fish company. That means they now own a tiny part of the fish, the ice shop, the fish profits, and possibly Penguin's future golden fish empire. So instead of being just random rich penguins, they are now investor penguins.
Why sell stocks? Because Penguin needs money to grow the business. Penguin can use that money to catch more fish, build more ice stores, hire more worker penguins, buy better fishing nets. What Penguin should not do is buy an ice Lamborghini, because if Penguin wastes all the money, the fish business dies, and then investor penguins become very angry penguins. What happens if business grows? If Penguin uses the money wisely, the fish business grows bigger. More fish, more customers, more profit. And if the business makes good profit, Penguin may share some of that profit with investor penguins. These payments are called dividends. So dividends are basically, thank you for giving Penguin fish money. Here, have some fish profit. Stocks versus shares. Now some penguins say stocks, some penguins say shares, and most baby penguins are confused. So here is the simple version. What are shares? A share is one tiny unit of ownership. So if stock is the whole fish business, then shares are the tiny pieces of it. Think of it like this. If stock is the whole fish pile, shares are the individual fish. So the more shares a penguin buys, the bigger the piece of the business that penguin owns. More shares equals more ownership. More ownership equals more power. More power equals penguin starts acting important. Different types of stocks. Just like not all penguins are the same, not all stocks are the same. Blue chip stocks. Some stocks come from big, trusted penguin companies. These companies are usually older, more stable, less dramatic, and less likely to explode tomorrow. These are called blue chip stocks. Penny stocks. Then there are small startup penguin companies. Penny stocks can grow very fast, but they can also crash very fast. So they are basically maybe genius, maybe disaster. What is the stock market? Now penguins need a place to buy and sell these stocks. That place is called the stock market. The stock market is where penguins go to trade ownership of businesses. So one penguin says, I want to buy fish company stock, and another penguin says, I want to sell fish company stock. Bull market versus bear market. Sometimes stock prices go up. Sometimes stock prices go down. Penguins use animals to describe this. Bull market. When stock prices are mostly going up, penguins call it a bull market. A bull market means investors are feeling dangerously overexcited. In a bull market, penguins think everything is going up forever, which is usually the exact moment everything goes wrong. Bear market. When stock prices are mostly going down, penguins call it a bear market. A bear market means investors are feeling scared, nervous, stressed, one bad headline away from panic. What is a fund? Sometimes penguins do not want to buy just one stock. That feels risky. So instead, they buy a group of stocks together. This is called a fund. A fund is like a big basket filled with many different penguin companies. This helps reduce risk because if one company slips on ice and dies, the others may still survive. What is the S&P 500? One famous fund is called the S&P 500. In penguin terms, This is a giant fund made up of 500 of the biggest penguin companies in the colony. These companies can include all kinds of businesses. So when a penguin invests in this fund, Penguin gets a tiny ownership in all 500 companies. That means Penguin is not betting everything on one fish stand. Instead, Penguin owns a tiny piece of the whole icy economy. This is why many penguins think it is a good long-term investment. Stock price goes up if more penguins want to buy it, the business is growing, profits are increasing, the company is opening more stores, or investors think the future looks good. So if Penguin Fish Company is doing amazing, more investors want in. More demand equals higher stock price. Very simple, very fishy. Stock price goes down if a stock price may go down when fewer penguins want to buy it. The business is struggling. Profits are falling, costs are rising, investors get scared. So if Penguin somehow eats all the fish profits, investors may panic. And if investor penguins panic, the stock price can fall faster than Penguin on black ice. So if baby penguin is still confused, here is the easiest version. A stock means owning a small part of a company. Penguins buy stocks because they hope the business grows. If the business does well, the stock price may go up. Penguins may earn profit. Penguins may receive dividends. But if the business does badly, penguins may lose fish money. So stocks can help penguins grow wealth, but they also come with risk, which is why smart penguins invest carefully and dumb penguins buy ice Lamborghini first. This video is not financial advice.